Investors always look for returns and profits. That's normal because the target of investing is return. In this series, I will analyze sector returns in the Saudi market from multiple angles across several videos. I want to understand how do they move, why do they rise, and why do they fall. And the main analytical question is what factors actually drive capital returns inside the sectors of the Saudi market. First of all, I have a quick reminder. In this series, I am using top-down analysis approach. I start from the country level, and today we move one step down to sector analysis. But before we begin, there's an important point about analysis, which is the financial analysis does not start with answers, but he starts with the questions, then builds assumption that can be tested and even rejected because the human mind naturally defends the idea it already believes in, and that creates bias and large decision errors. So, to neutralize this effect, we don't rely on impressions and we don't rely on personal belief. Instead, we test our assumptions through using scientific models designed to remove emotion and reduce bias. And this is the role of financial modeling. In this video, I follow the same approach developed by Yakov Amihud in 2002. In his well-known research on liquidity and returns, he tested his hypothesis on stocks listed in the New York Stock Exchange between 1963 and 1997. His hypothesis states assets that are harder to trade tend to offer higher expected returns because investors recur an illiquidity premium as a compensation for trading difficultly. Amihud also developed a liquidity measure that is now known as the Amihud Illiquidity Measure. In his paper research, he validated the measure and showed its importance in explaining return behavior in financial markets. He tested the relationship across stocks and over time, and while controlling for factors such as size, market value, and risk to make sure the effect was truly coming from liquidity. And his results show a clear positive relationship between lower liquidity and higher expected returns. Today, I will use a Amihud approach, but instead of applying it to individual stocks, I will apply it to sectors in the Saudi markets with the target of answering two questions. Does lower liquidity in the sector actually mean higher returns? And will this relationship appear with the same clarity in emerging market like Saudi Arabia? Now, regarding the data used in this analysis, it comes from the main market TASI from the officially Saudi exchange website. I relied on the monthly reports for 2025, then converted the data into Excel and built an analytical model along with a dashboard to clearly present the results. Now I will briefly explain the methodology and the steps I followed. It's based on a Amihud framework, but instead of applying it to stocks, I applied the analytical model to sectors. Step number one, I collected all the recorded data in Excel for every listed company across all sectors. First, I calculate the monthly return for each company, then I converted company level returns into sector level returns. Through that, I calculated the relative weight of each company within its sectors. Based on that, I calculated the weighted return of each company. Then I summed the weighted return for all companies in each sectors to obtain the total sector return. After that, I calculated the monthly illiquidity measure for each company. After that, I calculated the sector level illiquidity by multiplying each company's monthly illiquidity by its relative sector weight. Finally, I summed the values to get the total monthly liquidity for each sector. At this stage in this sheet, the sector level data is ready to apply a cross-sectional regression analysis, and right now I have sector returns, sector market size, and sector illiquidity indicator. Also, I transformed market size into its logarithmic form to convert large value into more linear structure suitable for regression modeling. Using the same approach applied by Yakov Amihud, after that I calculated the standard deviation for sector returns as a proxy for risk. Amihud combined these factors in his statistical model to make sure that the effect on returns was truly driven by liquidity and not by other variables. Then, using Excel, I applied regression analysis separately for each month. In each model, sector return was the dependent variable, while liquidity, size, and risk were the independent variables. So in total, I built 12 regression models, one for each month of 2025. In this paper, I summarized the results of all months to examine how the regression coefficients, the statistical significance, and the model strength changed from month to month. Now, based on this table, I will read the overall results for this model, but before look at the beta coefficients of the independent variable, which are liquidity, market size, and risk, I will look at the p-value or the hypothesis testing. We can see that the most of the values are above 0.05. This means there is no strong and statistical relationship throughout most of the year between sector liquidity, market size, risk, and changes in returns. However, limited significance appear in a few months, such as July and May. In July, the model showed statistical significance between liquidity and returns. However, the effect was negative and very weak. The beta coefficient was minus 0.054. This means the relationship was inverse. As the illiquidity indicator increased, returns decreased. In other words, lower liquidity in the sector was associated with lower returns. In May, the model showed statistical significance between market size and return, but again, the effect was negative and very weak. The beta coefficient for market size was minus 0.013. Overall, we don't observe a strong and reliable statistical relationship that we can depend on to explain changes in sector returns based on these fixed partial variables within this model. Now I will move to read R-square measure. R-square measures how much of the variation in returns is explained by the model. Its value is always between 0 and 1. The closer it is to 0, the weaker the explanatory power of the independent variables. And the closer it's to 1, the stronger the model is in explaining changes in the independent variable. In simple terms, it tells us what percentage of return movements the model can explain. If we look at the R-square values across most months, we notice that they were either weak between 0.15 and 0.30. This means that liquidity, market size, and risk together explain only about 15 to 30% of sector returns changes, and that is relatively low, which suggests that most return movements are driven by factors outside this model or possibly outside the market itself. However, September was different. R-square was very high, around 96%, but the explanation was mainly driven by risk with no strong relationship with liquidity or market size. And if we go back to the dashboard we built, we can clearly observe the effect in September. We can see a strong relationship between higher risk and higher returns. For example, the transportation and insurance sectors recorded relatively higher returns during the month, and those returns was associated with higher risk within the sectors, not with liquidity or market size. Now I will go look at the F-test. The p-value of the F-test evaluates the strength of the model as a whole. We can see that in most months, the p-value are above 0.05, which means that the model as a whole is not statistically significant in most months. So, the overall results is clear. The effect of liquidity, market size, and risk on sector returns in 2025 was not stable over time. Instead, it was influenced by factors outside the model and possibly outside the market itself. So, can we confirm or reject the hypothesis? Based on the results, we can say the following. Lower liquidity in a sector does not consistently lead to higher returns, and the relationship observed in developed markets does not appear with the same clarity in an emerging market like the Saudi market. So, based on these results, we cannot confirm or reject the hypothesis that lower liquidity leads to higher returns at the sector level, and there are two main reasons for that. First, the short time range. The analysis was based on only 1 year of data, 2025, and this period is simply too short to test a long-term structural relationship, especially when we compare it with Amihud study which covered several years. Second, the nature of period itself. During 2025, several external factors affected the market as a whole. For example, regional geopolitical tensions and the expansion of conflicts in the region, the targeting of Al-Udaid based on Qatar at the end of July, which we can clearly see reflected in the Saudi market performance during the period as shown in the dashboard. In addition, global monetary policy uncertainty and the unclear direction of the interest rate. And finally, the return of Donald Trump to the political scene, which also created uncertainty around future economic policies. These factors affected the market as a whole and weakened the natural effect of the internal variables. As a result, the effect of market size disappeared, the effect of risk became weaker, and liquidity did not show a stable relationship with returns. So, it's reasonable to assume that these shocks may have hidden the effect of liquidity, even if effect exists under normal market conditions. So what do we need to test this hypothesis properly? To examine this relationship in scientifically sound way, we need a long time period, at least 5 to 10 years, and also we need to exclude exceptional periods such as COVID period, and major geopolitical shock periods. This type of study requires a long time, a great deal of effort. That is why it's more suitable for master's thesis or a PhD dissertation, not just a short-term analysis. Finally, in upcoming videos, I will continue analysis the market sectors from different angles using dispersion measures, mathematics, and statistical analysis to better understand how sector return move.